Okay. Good afternoon and welcome. And thank you for coming to our webinar today. We're going to show you what we do and to identify for you how simple we keep it. There's been a lot of changes in our markets over the years, especially since the dot-com crash and all the other crashes. And I want to show you here something that's interesting. If you notice, we had the rally to the dot-com crash and then it collapsed. We lost about $5 trillion. But most of that $5 trillion, thank God, was with the institutions, the big guys. Not many retail customers got caught in the dot-com crash. But they sure got caught in the housing financial crash, which you know well, that everybody could buy a house and so forth. And then we had that crash. But this is the crash now that's amazing. This this market, again, it should have pulled back. If you notice, this one and this one, the dot-com crash, the housing crash, were designed not to go any higher than 15,000 by the bubble masters. Now, who are the bubble masters? The bubble masters are the very wealthy who control our market. There's about 2,300, 2,800 of them. These are very, very wealthy people. We call them we refer to them in the business as our owners, the owners. They control the country. Let's use 2,800 of them. 2,800, they have a net worth of about $138 million. Their income's about 27 trillion a year. I'm not talking about the 1 percentile. I'm talking about the 1/100th of 1 percentile. Because they control the Federal Reserve, they control the interest rates and so forth. But to go back a bit, if you notice, after this dot-com crash, they made sure they took the air out of the bubble, dropped it. The housing crash, they took the air out of the bubble and dropped it. But this one was different. They decided to keep going with it. That's when they started with zero interest rates. That's when they started what they call QE. All QE is they print all this money and they buy 10-year treasuries. And by buying the 10-year treasuries, they drop the interest rate on what they call the long-term rate. That's your 10-year treasury. That's the rate that is associated with what we have to pay on our national debt, which is associated with what you have to pay on a fixed rate mortgage on your house. So when those rates keep on going up, at some point the government can't afford to keep paying 300, 400 billion on the interest cost on that rate. It's just too much. And so then finally the market will just drop, and that's what happened over here. But what's happened here is that they decided to keep interest rates at zero because the wealthy, remember who's driving the market. Okay, it's the people. There's, the real investor that drives this market. Remember, 85% of their income comes from the stock market. This is not the retail customer. So keeping interest at zero, they could just keep driving this market. The market used to go up 70% of the time. It's changed now. It's going up 90% of the time because they've been able to put in another $5 trillion to keep pushing the market up, doing stock buybacks. Now, stock buybacks it was a criminal operation at one time. Reagan made it legal, but to buy your own shares, all you're doing it's really fake because when you buy your own shares, that means if you got 1 million shares and you buy your own shares, you got 500,000 shares left. When you spread your earnings or your profits over less shares, your earnings look a lot better than what they really are. And then that pushes up your earnings and it pushes up your stock. So it's all fake. So we've been doing this now. I mean, look at this. We just keep going on and we just do not stop. And what happened was when they decided to raise rates, because remember, the reason why interest rates go up, what causes interest rates to go up, is when an economy is doing well. That's because investors have the confidence to buy riskier assets like stocks. There's less demand for bonds. So the interest rates must rise to attract investors. Now, as you know, they're telling us how tremendous this economy is. It's great. It's terrific. But wait a minute. Then why are you fighting the interest rates? You're telling us how great the economy is. And when interest rates go up, that's what proves the economy is doing well. But you want the interest rate to come back down, but you're telling us the economy is doing well, so you got to be lying to us. Well, of course they are. So they want to keep the interest rates down so that the very wealthy can continue to borrow money at low rates, and also the corporations keep borrowing their own money, so they keep raising these interest rates. I mean, keep raising their earnings through stock buybacks. All you hear, we're in earnings season now, all you hear on all these financial shows on CNBC and Fox Business, earnings are terrific. Look, earnings are terrific. All you hear is earnings are terrific. They're all fake. And you hear them say, well, they're beating estimates. They're beating estimates. Well, they're beating their own estimates. If a company comes out and it's GE or Ford or whatever, they set their own estimate, and then they know they keep it really low. Then when it comes out, they beat it, so that the guys on Fox Business or CNBC can come out and say, "Oh, look at this! It's amazing. They're beating their own They don't tell you it's their own estimates, but they're beating estimates." So all I wanted to show you is the reason we're getting this big extension. They put another 5.1 trillion in of money to buy stocks, to keep buying their own shares. So at some point, this market is going to collapse. It's going to collapse under its own weight. You can't keep on pushing markets up by simply, buying your own shares back to push up your earnings, to push up your stock price. It just doesn't work that way, just like here. So now people are fearful of crashes. And it's amazing, as this market's been going up, they didn't come back into the market. When the market crashed back here, the housing crashed back here, people got out. All they did, they went to their broker and said, look, I just don't want to lose money. Put me in something where I just don't lose my principal. Just don't lose my principal. And they missed this whole market. They missed this whole rally, and they're stuck in something that was ridiculous, like bonds. So they missed this whole rally, it's just really too bad. Now, as far as, let's go back and take a look at what happened back here. This was Enron, okay? Now, when Enron collapsed, people lost a lot of money. They didn't know when to get out. First of all, if you're in a 401k, they're not going to tell you when to get out. The reason they don't, why do you think every crash that we've had, okay, if we go back to this chart here, why you're not told to get out? In fact, they want you to stay in. They never warn you to get out. And when you decide that, you call them, what should I do? What should I do? They try to keep you in. And they try to get you to buy more stocks on the way down. Because here's why. Because the 401k is a bad product. The guys who manage 401ks are the worst. Unlike the pension fund, you had experts managing the pension fund. They got paid on performance. And they didn't make money unless they were getting good profits. And then they benefited in those profits. When they switched from the pension fund over to the 401k, which was ridiculous, I'm going to talk a little bit about that later. When they switched over, the guy who manages the 401k, he's on salary. He has no incentive. He's a salary guy. So he could care less. But what he does, though, the incentive he does have is to keep getting more and more people to come into his mutual fund, because not only does he get paid on salary, but he also gets paid on how big the fund grows. So he has no incentive to get you out because it's against his own interest. He wants to make sure the fund keeps growing because he gets a bigger percentage of it plus his salary. So his incentive is the wrong way. His incentive is against you. So he doesn't want you to know what's going on. He's already going to tell you the economy's terrific, everything's great, because they want you to keep putting money in, and they want to keep building up that fund so they can get big, they make more money. So when do you get out? That's the big problem. People didn't get back in because they were so scared. They knew back here the crash, and they, even though they saw it going up, and they saw they're sitting on a sideline losing all this great revenue going up, they were fearful of the crash. So the way to identify when to get out is by following the big institutional money. Let's give you an example. What makes the market go up? We just talked about this a minute ago, okay, is QE. And what QE is, if you look back here, okay, this was the housing con. This is the one that the second rally we had. We first had the dot-com crashed, and then we had the housing con. And this is QE1, QE2. This is where they keep putting money in, okay? They print money. After the market crashed in 2008, they decided to print money. They printed $1 trillion and put it into the stock market, and the market went up 80%. Then they printed another, as the market started to pull back, they printed another $650 billion. The market went up 33%. When the market started to pull back, they did another QE. They called it Operation Twist instead of QE. And they printed and put $400 billion in the market, went up 28%. Then on October 2012, they printed $1 trillion, and the market went up 25%. So what they basically did is they took this market right here, this rally, okay, and they pushed it up, all fake, by QE, okay, printing money so they can borrow money free, borrow money at zero rates. The corporations and the big hedge funds and the big insurance companies and the big banks to buy stocks. And it's all artificial. And so, again, they push the market up. And this is what's going on today. So you just got to know when to get out. And that's the fear. Look at Enron. People lost a fortune in Enron. If you only follow the money, you just got to be able to follow the money. If it's the money that is pushing the market up, right here, as they're injecting money in to push the market up, this is what you follow. Okay, that's what you follow. It's not important to follow the company. It's not important to follow the company's fundamentals. Who cares about the company fundamentals? Company fundamentals means nothing to me because, again, I mean, I could look at the trailing PE, the forward PE, the PE ratios, price to sales, price to book, return on assets, return on equity, profit margins, free cash flow. I could study all that and get a team together and stuff. It doesn't mean anything. It used to. Years ago, it used to. Years ago, okay, you go back to the 50s, the 60s, we had a beautiful market then. Back then, a broker who used to get paid well, $125, he would work hard. He'd go find a stock, a company that was undervalued, and then he would find that stock for you, find that company. He would recommend his stock. You hold on for 10 or 15 years, and the company went up, not because they were printing money and sticking it in the market like they're doing today or like they've been doing for the last 10 years. A stock would go up because a company, they put good management in. They get new products, get a new sales team in there, knew what they were doing, and then the company grew. And people would buy more stock and grow again. People would buy more stock. Those days are gone. Those days are totally gone. So when they decided to start doing these bubbles, they didn't need any more of these researchers or anything else. They didn't need research. Matter of fact, there's nobody doing any research anymore. Why even have a research team? The whole market has been driven to just follow the money. And that's the proof right here. You can see it right here. And it's happening again. So I decided, when I saw Enron collapse and everybody got hurt, I'm saying to myself, all you had to know is they're pulling the money out, just like they're putting their money in. Are they pulling the money out? So I decided that I would put a chart together with the algorithms that follow just the money. And so if you had my chart when Enron collapsed, you would have known to be out. Now, this is not Enron. This is just I'm just using this as an example. It would have turned red. So the algorithms are set up to follow the money. Okay? So, and remember now how stocks go up. They print money and put it in. That's called QE. That's why Trump's saying he wants more QE. See, what they want to do now is keep interest rates low. But that goes right against, okay, the fabric of what we do. In other words, we've been always taught, I'm 73 years old, I've been in this market a long time, that when interest rates go up, that's a good thing. That means the economy's great, the economy's strong. You want interest rates going up. Now it's just the opposite. Now they're telling us the economy is great by keeping interest rates down. The economy is great by keeping interest rates at 2%. When for 40 years, I've always known when interest rates go up, the economy's doing terrific. Now it's just the opposite because they want to keep borrowing money to buy their own stock, like you see right here. So then let's just follow the money. Simple. If the money's coming out, my algorithms are going to turn the chart red. If money's going in, it's going to turn the chart green. It's that simple. Why do I need to do research? Sorry about that. What I knew to do, look at all the research you used to have to do. See, it used to be when you paid a broker $125, that was his fee. When you paid a broker $125, he did a lot of research. They had teams. I mean, it was amazing the research they did. But you got to understand, if you go back in history, what really happened. When our economy was a manufacturing economy, and everything was we were an industrial nation. And then at one point, remember, everything kind of changed. All of a sudden, we started to outsource. All of a sudden, we decided to change from a manufacturing-based economy. We decided to change more towards a financial service economy. And if you remember, when Reagan came into office, we just started globalization, and they started to send all of our good jobs overseas. And that's when the pensions changed, because remember what happened with the pensions. The retirement funds, they were a defined, guaranteed benefit, which you were guaranteed the day you retired, you would have enough income to live the same lifestyle that you came accustomed to while you were working. So everybody had pensions in those days, right? Everybody had pensions. And so once they started to get rid of these companies and we went global, and all of a sudden technology came into our lives. So Reagan, he comes into office, and at the same time he's in office, and we were sending all our jobs overseas, and we were becoming a tech nation economy. We had young entrepreneurs like Leonard Bozsik and Sandy Lenner. They were the founders of Cisco. They were working out of their dorm. We had people like Steve Jobs at Apple. We had Larry Ellison, Oracle. We had Bezos, Amazon, and go on and on. They're all working out of their basements, out of their garages, because they couldn't get funding. Because under Carter years, remember, he drove interest rates up, okay, and people just decided to put their money under the mattress because he said, I'm going to charge everybody 70%. That's when the tax rate went to 70%. So people were trying to find any kind of tax shelter. They were trying to take their money and put it under the mattress. Really, truly, nobody was investing. No, they're trying to hide their money. Nobody was investing. Reagan comes in, spots that. He spots the fact that these guys like Apple and they couldn't get out of their garages. They couldn't get out of their cellars. They couldn't raise money. There's no money on Wall Street. People weren't putting their money on Wall Street because why would you if you're going to get taxed 70%? If you buy a stock, your profits go up, you're going to get taxed 70%. So that's when Reagan turned around and he said, I'm going to drop these tax rates to 28%. I'm going to drop the capital gains. And so the dot-com era, the tech boom was started now in full swing because we can fund all of these companies. And that's when they started to bring companies public, and something changed. Remember, before, the broker was a true broker. He was a middleman. He got a real commission. Okay. He didn't own the stock. But what happened was things changed because when the dot-com started, and when you had the big investment banks, Morgan Stanley, Goldman Sachs, all the rest of them, they would buy the stock first. Because remember, they brought the companies public. In the morning, they would buy the stock themselves at $5. They'd bring the stock out at 10, 15. By the afternoon, it was at $80. You remember those days. Those were the good old, dot-com days. That was the first rally right here, right? That was the old dot-com days. So what happened is they had to get rid of your 401k. Number one, it was pensions. It was too expensive. Okay, and that's when they switched over to a 401k. Now remember, the problem with switching over to a 401k, the 401k was never a retirement fund. The 401k, remember, was a supplement to the pension fund for the CEO. When CEOs had pensions, they asked, and they got through Congress, if they could design a tax shelter for their benefits, for their bonuses. If they joined a golf club, if the company said, here, we're going to give you a golf membership, it was $30,000 a year, we're going to give it to you as a bonus. Okay, or they got a bonus at the end of the year. They wanted to shelter that. So what they did is they sheltered that income with this tax code 401k. It got approved by Congress because Congress was paid off and the CEOs paid Congress a lot of money and they got it through. So all the 401k is a supplement to the CEOs so they could shelter their funds, their bonuses, so forth, save tax money. Now, when Reagan comes into office, and all of a sudden we have the birth of the dot-coms because we're now, we have the money here. We're funding. People are pouring money in Wall Street, and the reason the dot-coms and all these stocks went crazy because we had more money than we had stocks available. Because for 8 years, because of the peanut farmer, people were staying away from stocks. There were no IPOs. There's no companies coming out, no new companies. So all of a sudden, everybody was running to Wall Street, and the sun, the star, the moon, everything just was coming together perfectly. As Reagan changed the tax law, everybody's running to Wall Street. They want to start investing. They look around, there's not enough stocks. But it just happened to be. Globalization was taking all our companies out overseas, and we had this new thing called dot-coms. And people went nuts. And then they decided, let's get rid of the pension fund. It's too expensive. Let's screw everybody. What we'll do is we'll tell them that the 401k will stick in it a mutual fund. So they take the 401k tax, which remember was a supplement to the pension fund. They stick inside it a mutual fund. And then they call it a mutual fund retirement fund. Well, remember what Ted Brenna, who is the one who designed the 401k supplement to the pension, he was outraged. He said, wait a minute, the 401k, I designed it. You can't retire with a 401k. You're not going to get enough income. It's not set up. But remember, Wall Street, the mutual fund was a tiny, tiny little part of Wall Street. It was a cottage industry. But they saw a great opportunity. Now they could switch. If they all got together and they said, okay, let's screw everybody. Now this little tiny cottage industry mutual fund became huge. It's the biggest thing on Wall Street now because they could take that mutual fund, stick inside the 401k and call it a retirement fund. And Ted Brenna, they tried to shut him up. He was out there, but nobody would listen to him because the mutual fund industry with the 401k were spending billions and billions in marketing. They would have advertisements on TV where they show a guy in Vermont, he and his wife in a log cabin, and Bammy the deer jumping over the little creek, and the cabin's all the flowers and beautiful, and they're in their LL Bean suits and shirts and all that crap. And boy, you can retire. Or they have another ad showing you and your husband walking down the beach in Florida, right? And you can retire with your 401k. All a bunch of garbage, because the 401k is a nasty thing because, first of all, And I'm not going to talk about your 401k all day here because I'm trying to tell you what I do. But I can tell you the 401k, the fees are way too high. They're very dangerous. You can't, when the market starts crashing, they don't let you out that day. You have to wait the end of the day or the next day. By then, you could lose 30, 40%. When the market starts crashing, you can't mitigate your losses by turning and switching. The fees are just absolutely terrible. You got 27 hidden fees. It's the biggest skimming operation ever. I can take my spiders. I can take my spiders and just manage my spiders, which what we do here. We have 5 products. Okay, these are the products. We have Goldman Sachs, Intel, TCAT, Schlumberger. These are our 5 individual stocks. This is our portfolio. We have 5 individual stocks. We have 3 indices. This is the spiders, the banks, and the mid-cap stocks. These are what you call indices. This is where all the money goes. Spiders, XLF, IWM. Small mid-cap stocks, banks, and this is where it is right there. It's all the big money. We picked out what we thought is the best 5 stocks. And then we have the ETFs. We have the semiconductor, so you can buy a basket of semiconductor. Excuse me. We have the XLK. That's the ETF for big tech, Apple, Microsoft, Oracle, the FANG stocks. You can buy a basket of them. XLI is the industrials, very, very important. Industrials and banks and semis. That's what drives the market. Industrials is your Lockheed Martin, your Boeing, your UPS, your engines. Your industrials are so important. And then XLB, your materials. That's like your aluminum and so forth and all that. And then, of course, retail, and, of course, energy, oil, and so forth. So all we do is we've taken the pain out. You go ahead and take your money, put in a 401k. I'll put my money in the spiders, and we'll keep it in for 20 years. Okay? And what I have to pay for a fee on the spiders compared to what you got to pay with 401ks, if you were in a 401k with the spiders and I'm just managing my own spider with my chart, I sell the stock short, make money when it goes down, which you're not allowed to do with a 401k. I buy it when it's green. All I'm doing is following the money. At the end of the same term of years, I'll make $300,000 more than you will. When the day I'm ready to retire, because the fees are so outrageous with 401ks that when we both retire, I'll end up walking out with $300,000 more than you because of those fees. And remember, if you take a mutual fund, now remember what this 401k is. It's a mutual fund stuck into a product that's not been designed for retirement. It's been a scam. And it's the only product Americans buy. They don't know the price of it. You don't know the quality of it. You don't know the danger of it. Because of billions and billions and billions of marketing, you can't fight these people. The 401k is a defined contribution plan, whereas the pension is defined guarantee. You get guarantee, but those are gone. Those are gone. Remember what made America great was when you went to work and they gave you a pension. What built America as the greatest country was the middle class, because when you went to work, there was a contract. A pension was a contract. A pension said the management would say, look, we're going to make sure you have the best retirement ever, but you got to make sure you build the best products ever, okay, at the cheapest price, the best quality, and we both win. And that's why we grew, and that's how the middle class grew. Because remember, it was the middle class that built this country. And the middle class, when we had the pension funds, everybody was doing terrific. But then when Jimmy Carter came in, and then remember what happened? Then they decided to get rid of the industry, outsource everything. They couldn't keep pensions anymore. We switched to this con job called the 401k. And again, I'm not here I'll never convince you to get out of your 401k, nor am I trying to. Your 401k costs 7 times more than the ETF. If I go ahead and if you join my gang, and here's what we do, and if you take these are the only stocks in our portfolio: Goldman Sachs, Intel, These are the only stocks. And we follow the buy and sell signal. We tell you when to buy and when to sell from the green to the red. You haven't got to do a thing. We tell you exactly what to do at 2 o'clock Eastern time. We tell you exactly what to do with every stock. Okay? And you don't have to do every one. You just do one. Just pick one. And 2 o'clock, if you go by our instructions every day and we instruct you based on our color code, and we explain to you why we're doing it, you don't have to know anything. You don't have to know anything about the company, nothing. And by the way, it doesn't make sense anyways, because the reason why companies are going up, companies aren't going up because of their margins. Companies aren't going up because they have good free cash flow. Companies are going up simply because they can borrow money cheaply and buy their own shares. And then they put a story with it. And Trump wants to make sure we go back to QE and keep the market going up until he gets elected. So my point is, the important thing is like a car. Would you buy a car with no reverse, just forward? Well, why would you be in a 401k or buy a stock you can't short? You can't mitigate your losses. Look, if you have a stock, like look at right here. This is our spiders right here. See when it was coming down? When it was red, we're giving you instructions, and we're mitigating any losses. We're making money on the way down. Okay? And then we tell our gang, okay, when to buy it. It turned green. And we instruct you through it. Tell you where to put your stops and so forth. But here's the thing. Anybody can make money on the way up, especially now that stocks go up 90% of the time because the stock market is being manipulated, right? It's being financially engineered with QE. So the important thing is to get you out in time. Here's a good example. Look over here, the spiders. It was green. We're making money. We guide you all the way through. You just listen to what we say at 2 o'clock in the afternoon, and then we tell you when to sell. And then not just get out, we tell you how to short it. So we're holding your hand all the way through. And this, again, as I say, you can decide if you want to do all five individual stocks or one or two, or you can decide just to do the three ETFs, indices, or you can do the ETFs, one, two, or whatever you decide. Now, I suggest, and I'm going to be handing you over to Steve in a second, he'll go through all this with you, but what we do is we suggest that when you start out, if you join the gang for $39.95, okay, what we're going to do, because you showed up here today, we're going to give you free this chart, okay? So for the first month, if you just follow what we do for the first month, based on, we give you instructions, whether to buy or to sell short or to hold, based on the color code here. If you just follow us, whatever stock you decide or ETF you decide, one, two, it's up to you. If you just follow us to the T, don't go off the reservation, you're going to do just fine. You're going to do great. It's that simple. So I could sit here all day and tell you how bad 401ks, but that's not going to get me anywhere because I'll never convince you of that because I can't go against the billions and billions and billions of money they spent to tell everybody it's the greatest thing since Swiss cheese. But I can tell you this. I know one thing. People don't have time. They're busy. They don't want to. They don't have time to learn. Now, if they do want to learn, of course, then we also have our other chart called our MV1 chart, where people come in and they can trade on a shorter time period. Okay, and Steve will go over that with you. In other words, you can start out here if you want. Then you decide you want to be an activist investor. You want to trade in a short time period, 2 to 5 days. We have a whole teaching program about that. You come into class every day at 9:30 in the morning to 11 o'clock. You ask questions about your stock. We instruct you what to do with it. We teach you patterns. We use another chart for that, and Steve will go over that with you. I'm here to explain to you right now. I'm going to give you this chart free if you join my gang today, $39.95. Okay, got to join today. And then let me prove to you, okay, keep your 401k. Let me prove to you this will be so easy for you. You would make more money than you ever would your 401k just by saving the expense, for God's sakes, okay? Just save the expense and commissions. So that's how this all works. So what has happened is I, being this old, 73, watching this market my whole life, I said, no, it's come down now to just watching money because that's all they do. If you watch the money going in, it's going to go up. If you watch the money going out, that's the trick. The trick is to get out after you have the run. See these runs like this where they're green? See these runs? These are easy because the stock always wants to go up. Stocks always, like I said, even before they did all this stuff, QE, stocks went up 70% of the time. So all you got to know is when to get out. And if I can tell you when to get out, and you'll see yourself, because if you join the gang today and you start following me this month, and you can follow any stock you want, because every afternoon we give you instructions on each one and each ETF. And you're going to find out, okay, it's all about the money flow. It's that simple, okay? We simplified it. And you're going to say, God, this is pretty easy. So that's what we're about. Okay, I hope you enjoyed. I went over a little bit longer than I should have. Okay, but I hope you enjoyed this and a little bit of the history background. As I say, I'm not here to beat up your 401k. I'm not here to try to talk you out of it. Okay, I'm trying to tell you to supplement it. That's all, just to supplement it. And I think you'll find after 1 month, just try 1 month, and then and then you follow any one of the four, any one of the five stocks, or any one of the three industries, or any one of our ETFs right here. Just stay with these. You'll love it. It works. Okay. All right. So I'm going to turn you over to Steve. So remember today, make sure today you to get the chart free. Just join the gang, $39.95. And I'm going to tell you this: we hold your hand all the way through. There is no way that you can make a mistake. If you decide to buy AT&T and then at 2 o'clock you get our instructions what to do, or you decide to buy the spiders or the big tech stocks, there is no way you can go wrong as long as you follow our instructions. And if you're confused, you contact us. We support you. You got your own private coach telling you, yes, you should do this. No, you made a mistake. And we guide you. So many people do this now. So please stop. Don't think of this. You got to watch TV and you got to run to a broker because you need to know all this crap here, which they don't even look at anymore because none of it applies. Because they're pushing companies up that are $5 companies up to $100 when the company's worth no more than $5. There's stocks that are up to $200. The companies aren't any worth more than $20 the stock. But the stock is going up not because it's a good investment. It's going up for one reason. QE. Keep interest rates low. The big boys, the hedge funds, the big hospital, the big institutions, the banks, the insurance companies, keep buying and keep buying. And that's what's going on. But you're going to enjoy it when it breaks and goes all the way down as well. Okay, so I'm going to hand you over to Stephen. Hope you enjoyed this little history lesson and what we do. Okay?
Okay, gang, just hold on 1 second while I change my screens here. In fact, if you need to get up and maybe go to the restroom, right now is a good time. I'll start here. I'll take over here in about 5 minutes. So if anybody needs a break, I'll be right back here at about a quarter till. Again, if you're just joining me and Phil, we're just on a little bit of a break. We'll be right back. Again, gang, we're just on a little bit of a break here. We'll be back right at 12:45. We'll be right back in about 2 minutes. Okay, gang, and welcome back. My name is Steve Celeste. I'm a senior technical chartist here at philsgang.com and the Phil's Gang radio show. And Phil really touched on a lot there. I mean, about the history of the stock market and where we're at today and where we're going in the future. And basically, you know, the government has gotten so used to QE and quantitative easing that Phil really believes that it's never going to go back to the old ways. Okay, where basically the market looked at the smaller companies and organizations to drive the market. They just don't really care about it. As long as they can keep printing money, they'll even pay higher interest rates. They don't care as long as they keep the market up and people think that the economy is good. So, all right. So what we do here, what I'm doing here today, is just to let you know now that Phil has you engaged in the market a little bit. I'm here to get you more engaged in Phil's Gang and philsgang.com and let you know what you got to do to join. Okay. So if you're going to join today, of course, Phil has the offer. The membership is $39.95 per month. your first month will be free of the MV2 software. So you'll get that free today if you join today. All right. So that software, if we go up here and visit our store real quick, you can go right here. You can see that the one we're giving you for free, if you're a gang member, you get it at $24.95 a month because you're a gang member, and we give you a little bit of a discount. If you wanted just the software, you could get that for $29.95 a month. So you're getting basically a $30 piece of software for free for the first month. Okay. So let me go back to the home page here. And what I'm going to do is I'm going to click the Y join. And this is, basically Phil gives you a little video here on our charts. And then this is what you get every day. You get Coffee Talk, where Phil's basically going to welcome you to the day every morning. He's letting you know what's going on in the market. Okay. What he does is he gets up and he's watching the stock market about 3 o'clock. Yeah, it's about 3 o'clock in the morning. He's watching Asia and Europe and Japan, and he's basically looking at those markets to see how that's going to affect our markets for the day. Okay, he's watching the Fed. He's watching all these little things that help decide what our market's going to be like, and then he's letting you know. Okay, and that's posted on the website every day, no later than 8:30 in the morning Eastern time. All right, and then after that, we do our live trading class, which starts at 9:30, which is very much a live webinar, just like what we're doing right now. Okay, that class is an hour and a half long, and Phil does the first 40 minutes of the class, and then I come in usually about 10:05 to 10 after 10, and I will start taking questions from you guys. Okay, so if you have a particular stock that you have a question about, I start answering it for you. Right, I'll answer that question. So say you have something like, I don't know, American Airlines, right? And you want to know what to do with it for the day. Well, on MV2, it's pretty clear because our rule is if it's green, right, we stay with it. Even if it pulls back a little bit, and you can see it did here, it pulled back. But as long as you stay with it, you know the institutions are still buying the stock, and eventually the stocks rally back up. And if your stochastic is telling you, hey, the long-term direction of the stock is moving up, then we stay with it. All right. And you have really, really good, especially in your ETFs or your indices, like Phil was saying. I mean, you get really good returns. With something like this, you're not buying here, right, and then getting out down here or up here on these little pullbacks, right? So let me draw something for you so you can see what I'm talking about. Right in here, right in here, right in here, and here, there's these little pullbacks, right? Now, if you're over here on MV1, you play those pullbacks, right? You play them. And so you're basically buying, down here, you get out here, right? And then it's the same thing. You buy here, you get out up here, so on and so forth. What I find is that as you do this throughout the year, you accrue a bunch of broker fees, right? The broker fees start to add up. If you're paying your broker, anywhere from $5 to $7 per trade, that means per trade means and out. That means you're paying upwards of around $14 just to buy in and get out of a stock. So right, so like right here, that's $7. Now you're $14 in the trade, $21 and so on, $28, and it just keeps on going up the ladder for the year. With MV2, it's a long-term situation. You're not doing all that. All you care about is that this thing is green. You buy in down here, you stay in till way up here when it finally turns red again, and looks something like like this, right? That's when you would get out. So you're making your profit from here to up here. So that's kind of what we do here, and that's what we explain in the live class every morning from, again, 9:30 to 11. Let me go ahead and clear this up for us. Then also in the live class, we do a lot of swing trading, okay? And that's basically what we do in the live class. It's mostly swing trading where we're looking at this chart. We'll cover Phil's 5 stocks, right? Phil goes over those in the morning. And again, I'm answering your questions. So you email us with a stock question and I tell you what to do with it, okay? I tell you, hey, look, your stock is maybe going above resistance here, now you can add to it. Or I say, oh, your stock is going into resistance, you can't add to it because resistance equals heavy selling, so you're not going to do that. And by the way, if you're in it, make sure you keep a stop in it down here, and I'll give you exact numbers. Okay, I'm not just going to say just put it here. I'm going to say, look, put your stop at 154, 51 right underneath your S1. I'm going to tell you how to put in your stops. I'm going to tell you when to add, when to get in, when to get out. I'm going to explain volume to you. I'm going to explain bid and ask prices and the differences. I'm going to really try and drive this home for you. And it's very repetitive every day. My answers are always going to be the same or similar, based on the stock, because what I'm doing is I'm teaching you pattern recognition. All right. And if you understand the patterns, then eventually you'll be able to do this on your own, where you can cancel the gang membership if you want and just subscribe to the charts, and then you can literally trade yourself because you're going to have that confidence because you know the patterns. You're going to understand support, you're going to understand resistance, you're going to understand volume and moving averages and stochastics. These are all things that as a new person, it's going to sound very scary. It can be overwhelming a little bit. But if you take the time, you put in a good amount of time into watching that class every morning, then you'll really do well. And that's only if you want to be a really, a good active or activist trader where you have a lot of action every day. Now, we also have another chart called the MV3, where it's a 15-minute chart. And from this white line here to this white line here, all these candles represent one candle over here. So you could do a lot of trading inside these candles and make a lot of money. We have a guy out in San Jose. His name's John. He's a day trader. This guy's making anywhere from $3,000 to $15,000 a day, and he trades a lot of shares. But it's just by following our rules and watching our 15-minute chart. All right. So now what we're going to do is I'm going to pop the website back up here for you. Let's see here. All right. If that's too much for you, if it's just too much action and it's overwhelming, that's where the working investor comes in. And what the working investor is, you can skip this, you can skip this. You don't have to do market wrap. You don't even have to pay attention to the alerts. Okay. Which, by the way, if you're doing coffee talk in the live trading class every day, we do a market wrap at the end of the day. And there's alerts that come throughout the day. All right. And to subscribe to those alerts, you just click this little red bell down here, this little red and white bell in the bottom left-hand corner down here, and you'll get notifications. Okay. This is a notification system. And then once you actually see the notification, then you log into the site, you click the alerts button here, and that brings you to this page here. Now, right now you won't be able to get to this. It's a gang member privilege, okay? And you'll see any of our long positions will be here for the day. Any of our short positions will be here. And then any kind of general alert, maybe something, maybe the Fed did something that Phil wants you to know about, or Phil just wants you to know about something in general, it will be right underneath here. Okay. So let's see, what else do we have here? So back to the Why Join page. We also have a full video library for training, support, and then we've also get some, some free videos, which this is all right up in here. All right. And you'll see here we've got general classes. All right. So general training. You can come in and watch any of these videos. And of course, if you have questions on any of these, there's a way to contact us down here. If you have support questions, they're all in here. If you want to train on, MV1 or MV2 or MV3, they're here. And then, of course, there's full pattern recognition right in here where you can see we have a bunch of videos that teach you different patterns, and you can always go back 24/7 and review these things. All right, so let me go ahead and close that. I'm going to close this. Now we're back to why join again, right? So pretty much that's it. I think I've got it covered. I mean, you join so that you can make profits, so that you can take control of your future. You take the money away, or you're not taking it out of an account. I mean, you still, in order to be a Phil's Gang member, you have to have a brokerage account. Okay, we recommend Choice Trade, which is 0 per trade, by the way. We recommend Robinhood is also 0 per trade. Another very popular broker is TD Ameritrade, which is actually $6.95 per trade. But they give you really good trading software, and they also offer paper trading. Okay, that's called Thinkorswim, and you can get that for free when you open up an account with them. There's also Interactive Brokers. Now, Interactive Brokers is tough. If you're an experienced trader, then they want like a $10,000 account, and they'll help you out. If you don't have any experience, they won't even talk to you, so don't even waste your time with them. But Choice Trade, Robinhood, and TD Ameritrade, they have great support systems, and they'll be happy to help you out. So now let me tell you how to join. All right, just go right up here to the top of the site in this blue bar, right up here, or even down here. You can click Join Now. Once you click Join Now, what happens, let me show you, is it brings you to a shopping cart, kind of like Amazon. In the shopping cart, you'll notice that you already have the Phil's Gang membership sitting here for you. You just have to scroll down, click Proceed to Checkout. Once you do that, it brings you over here. Now you'll see I've got some mock stuff in here already. You just fill out this information, get to the bottom here, you're going to put in your credit card information. You have to check in this box right here that says that you've read and agreed to the terms and conditions, and then click Place Order. Once you've done that, within about 15 to 30 seconds, you'll get a reply from the website letting you know that your order was received, and now you're a gang member, and all you got to do is make sure you're logged in every day. Once you do that, you're good to go. So if you have questions, feel free to email me directly at support@philsgang.com. I'll be happy to answer those questions for you. If you, once you join, I will go in and I will add that MV2 product to your account. But you got to join today in order to get the free software. All right. So we're down to our last second here. I think I pretty much touched on everything. Again, I'll be here for about a half hour to answer questions. If you have any, again, email me at support@philsgang.com. All right. Thank you guys so much for showing up to our free webinar today. That's it. We'll see you on the charts. Have a great rest of your weekend.